Welcome to the Money Metals Midweek Memo, news and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Maharrey. Thanks for tuning in. So there's a new boss over at the Fed. There's no doubt that Kevin Warsh is going to be a different kind of Fed chair. He's definitely not Jerome Powell. And he's already started putting his stamp on the central bank with his first FOMC meeting last week. But folks would do well to remember that the new boss is running the same organization and facing the exact same problems as the old boss. And no matter how different he might be, no matter how differently he may want to run things, that reality is going to limit what he can actually do. And that means that things may not look a whole lot different, even though it seems like people are really anticipating a much more hawkish Fed that's going to slam down inflation and everything's going to be hunky-dory. So, that said, they're definitely going to sound different. Things are going to look and sound differently over at the Federal Reserve. And it's important to cut through the noise if we're going to get a clear understanding of what monetary policy will likely look like going forward. And of course, if you are a precious metals investor, this is one of the biggest factors that's going to impact the price of gold and silver. It's the anticipation of what the Fed is going to do with monetary policy. And right now, I think the anticipation and the narrative is out of step with reality. So we're going to talk about that today. But first, again, as I always say every week, thank you so much for listening to the show. I really do appreciate it. I know there are all kinds of things out there vying for your attention, so it means a lot to me that you spend a little bit of time each week with me. If you would do me a favor, please share these episodes on your own social media channels. That will help us to grow the show. Also, if you would, write us a little review, give us those thumbs up. All of those things tweak the algorithms and will show the show to more people and help us to grow. If you would do that, I would greatly appreciate it. So before we get into the news of the week, I did want to talk a little bit about where I was last week. You probably noticed, if you're a regular listener, that I did not record a show, and that is because I was in Mexico with a group from my church, and we actually built a house for a couple who... Basically, a lot of folks in this area of Mexico are able to scrape up enough money to buy land, but then they struggle to put any kind of livable structure on it. The average salary there is around $250 or $300 a week. So you can imagine the level of poverty. And so we were able to build a house basically in 4 work days, which was pretty amazing. I will say this, at almost 60, I'm too old to do construction work in the desert and sleep in a tent, but I made it. And it was a fantastic week. I kind of wanted to share 2 things that kind of struck me that are at least tangentially relevant to what we talk about here on the show. The first is just the fact that, it really drove home to me the fact that we are blessed beyond comprehension here in the United States. Just going over this line that's drawn in the sand, it was night and day. It is a huge difference. Folks that have been to Mexico, outside of the touristy areas, this. You've experienced this. And I think a lot of us know it intuitively that we are blessed here in the U.S., but to actually see it and to realize that, if I had been born just in the different place, my life would be completely different. And I think sometimes we need to stop and appreciate what we have here in the United States. And, I think ultimately it's because this country, for all of its faults, was built on the idea of individual liberty and, our ability to pursue our own ends. And that has created an economic powerhouse, and we get the benefit from that. Folks that are relatively well off in Mexico would be considered poor over here. And it's just striking. So, take a minute and just be thankful for what you have just by honestly the luck of your birth. And then the second thing that really struck me is that, the regulatory system in Mexico is a little different than it is here in the United States. And by a little different, I mean it doesn't really exist. As I said, we built a house and we didn't pull one permit. We didn't talk to one inspector. We didn't interact with one government agent the entire time we were there, and we built a house. And I guess there are a lot of things that you would look at over there and say, ooh, that's not up to code. On the other hand, they can't afford for them to be up to code, right? Folks are scraping together and trying to live with whatever they have. And the lack of regulation is probably a blessing for them. Same thing with like selling stuff. You go by the market and it's pretty amazing. There's just, hundreds of people selling stuff on the side of the road, food and clothing and all of these things. Again, nobody's getting a permit, right? There's no food inspectors. And it would be interesting, I think, to actually do a study and see, are foodborne illnesses more common in Mexico than they are in the United States with the lack of that kind of regulation. So that's just interesting to me, I think sometimes our overregulated economy is just a result of our affluence. We can afford to worry about things like that. And, when you're really just wishing you had a concrete floor, things get a little bit loosier and goosier. And so I just thought that was interesting. So that was kind of the two takeaways. I could sit and talk about my trip all day, but that's not why we're here. So, let's talk a little bit about what's going on in the gold and silver market and over at the Fed. Of course, while I was gone, we had the June Fed meeting, and it was the first meeting by new Fed chair Kevin Warsh. So we kind of got a sense of how he's going to run the ship over there. And I want to talk about that. I want to talk a little bit about just kind of what's going on with monetary policy. So if you're watching the ticker this morning, you will notice that gold is once again getting pounded down. It got pounded down again yesterday. And it looks like we're going to test the $4,000 an ounce level. And meanwhile, silver has dipped to below $60 an ounce. And, for the last several months, gold and silver have both been reacting negatively to any negative war news. So whenever we got, any hint that the war may drag on, that negotiations were breaking down, we would see gold and silver sell off. And as I've talked about over and over on the show, this is primarily due to the fact that there's this anticipation that the longer the war goes, the more deeply entrenched the inflationary effects of rising oil prices is going to trickle through the economy. That's going to force the Federal Reserve to hold interest rates higher for longer. And that is negative for gold being a non-yielding asset. That's the narrative. Now, it seems that even good war news doesn't soothe the precious metals markets, right? It looks like we're making progress towards some kind of peace deal. Of course, we don't know for sure, but there has been this memorandum of understanding that has been signed. It does seem like we're moving in a positive direction, and yet gold is still selling off. And again, we still have this mentality that interest rates are going to stay higher for longer. That is really the driving thing in the gold and silver market right now. Everybody is convinced this is a higher for longer interest rate environment. Meanwhile, we've got a strong dollar because everybody's thinking, okay, the war risk is unwinding. The U.S. is going to go gangbusters, and the economy's doing great. The data seems relatively positive. So the Fed is going to have to keep rates higher, and we're going to have a strong economy. So that's really kind of the mentality that we're seeing here. And, I initially thought that an end to the Iran conflict would set the gold and silver bulls loose once again, because again, all of the underlying dynamics that have driven gold higher over the last couple of years are still in place. But I've become very near-term bearish. I think we could see gold trade below $4,000 an ounce for at least a little while, until something cracks in the economy. I think the Feds are going to try to hold rates higher. I think Kevin Warsh is sincere when he says he wants to fight the inflation dragon. But I'm still long-term bullish because, again, those factors that have driven gold and silver higher over the last several years are still in place, right? Number one, inflation isn't going away. As I've said over and over again on the show, inflation is the plan, right? They want to inflate the dollar by 2% every single year. That's 5% or 10% 2% every 5 years. So it's a significant devaluation of your money. That's the plan. They just want to keep it low enough so you don't get too angry about it. And, I did an article while I was away that published last week talking about the fact that Kevin Warsh has talked about the fact that he would rather use what he calls a trimmed average to evaluate the CPI. And that basically means you take the high and the low number on each end, and then you use the average that's left. Really, what that is, it's a way to understate inflation even more. It makes the inflation situation look better than it actually is. That's their goal. That's what they're doing. So that's number one. Number two, we still have a debt black hole, and it's getting bigger. Debt-riddled economies need easy money. How long the Fed can hold that easy money back, that's anybody's guess. But we know that ultimately this economy is going to need that injection of monetary stimulus. And number three, the de-dollarization trend is still in place. Central banks are still buying gold. There is still a wariness of the U.S. weaponizing the dollar as a foreign policy tool. And there's a lot of growing concern out there about the U.S.'s fiscal situation. The world doesn't trust the U.S. or its currency. So those things are all in place. And I think those are the long-term drivers. But we've got this mentality, this narrative that's going on now. And Kevin Warsh is feeding into the higher interest rate for longer narrative. Right? We have a new sheriff in town at the Fed. And he sounds a lot different than the old sheriff. But again, one would be wise to remember that Kevin Warsh is enforcing the same laws in the same town as the old Sheriff Jerome Powell did. And while the June FOMC meeting sounded and felt a lot different, it looked exactly like the previous meeting, right? The committee held interest rates steady between 3.5 and 3.75%. And the committee hinted that there could be a rate hike before the end of the year. And that's basically what we heard during the last Fed meeting as well. I would argue that Warsh is maybe even a little bit more hawkish than Powell. He talks a good game. But when you look at what they actually did, not a bit of difference, right? However, as I mentioned, there was a lot of hawkishness in the previous meeting as well. However, the committee seems to be more unified in their views right now. The vote to hold rates steady was unanimous, and most of the committee members seemed willing to entertain the possibility of a rate hike before the end of the year. And the thing that I think is going to be a lot different, that's going to take a little bit of getting used to after the Powell regime, is that Warsh has a very different communication style. The official FOMC statement was much shorter. It was just 130 words. And that's a lot shorter than the statements that we got during the Powell era. And Warsh actually addressed the brevity of the statement during his press conference. He said, quote, "It's a bit shorter, it's a bit simpler, and it dispenses with some older language. That statement just gives you the facts as best we can judge it." So there you go. Cut and dry, no nonsense. The statement did emphatically assert that the Fed, quote, "will deliver price stability." And that hints at Warsh's commitment to fighting inflation. And we heard that over and over again. That was a recurring theme for this meeting. However, the FOMC statement actually erased any clue as to what the Fed might do next from a policy standpoint. And Powell was big on kind of signaling, right? We're kind of thinking that we might have an easing bias moving forward, right? That's kind of where we were. That's gone. You read this FOMC statement, no clue, no hint at what the next move might be. And the new Fed chair reiterated this messaging during his press conference. He reminded listeners, quote, that persistently high prices are a burden for the American people. True. And he assured us, quote, "members of the FOMC are unambiguous and unanimous. This committee will deliver price stability." Right? So that's where we are. We're going to deliver price stability. The markets are listening to that. They're saying, ooh, hawkish Fed, higher interest rates. bad for gold. Now, apart from the aforementioned assurances, Warsh gave very little indication about the future trajectory of monetary policy. We saw that in the statement, and we also saw that in his comments during his press conference. He even refused to submit data for the latest dot plot projections. During his press conference, Warsh indicated that he's not a big fan of what he called forward guidance, which, again, was a staple of the Powell regime. Powell wanted you to know this is where we're going. Probably. Warsh apparently doesn't want you to know. He's going to leave you guessing. This is what Warsh said. He said, I did not submit a dot for me. It's not helpful in the conduct of policy. I suspect by year end, as I mentioned in my opening statements, there will be a review about communications broadly, press conferences, dots, meetings, and the like, transcripts, minutes. This will be part of that. I don't want to prejudge the outcomes here, but I'm pretty open-minded about what they could be. So he's hinting that we're going to get rid of a lot of this stuff, a lot of this communication that Powell did. I like to call it open mouth operations. Powell liked to try to move the markets in the direction he wanted them to go just by talking. It appears that Warsh is not going to do this. So in practice, this means we could see more, quote, surprise moves by the central bank in the months ahead, where the committee does things that people aren't expecting, which will certainly cause a lot of turmoil and volatility in the markets, at least short term, when that happens. The bottom line is Warsh seems much less inclined to telegraph what the Fed might do next. Now, I mentioned the new dot plots. It erased any indication of a possible rate cut this year and hinted at the possibility of a rate hike. The median rate projection was 3.8% by the end of the year. That's up from 3.4% in the last plot. So there's definitely a bias towards higher interest rates. I will say this, though. Warsh is right about one thing. These dot plots are pretty useless as a forecasting tool. I've mentioned this before, but a fund manager named David Hay, he actually analyzed past dot plots. This is a couple of years ago that he did this. And he found that the FOMC only got interest rate projections right 37% of the time. And as he pointed out, they actually control the interest rates. So, these things are beyond useless. You might as well throw darts at a dartboard or, flip a coin. I'll give you an example. In March 2021, the FOMC projected that the interest rate would still be zero in 2022. The actual 2022 interest rate was 1.75%. And in 2023, the vast majority of the FOMC members thought the rate would still be zero, and the actual rate was over 5%. So they don't know. They don't know. That's the bottom line. And, from that standpoint, the fact that Warsh wants to stop with the forward guidance probably makes sense. I mean, why try to forward guide when you have no idea what's going to happen going forward, right? But here's the bottom line. Cleaning up messaging, that's one thing. Actually getting the job done, actually slaying inflation is something else altogether. And again, inflation is the plan. So what they're trying to do is they're trying to keep inflation at a level that is acceptable for what they need to do policy-wise, but doesn't make you mad. So yeah, it's easy to stand up there on a podium and say, we're going to bring inflation back to that 2% target. Right? It's easy to stand there and say, we can hike interest rates, we'll get this under control. Delivering on those promises will not prove as easy. And as I've already mentioned, it's important to remember that Warsh is operating in the same economic environment, the same monetary policy environment as Jerome Powell was. The debt black hole still looms large, making rate hikes a dangerous prospect. In fact, holding rates steady may be enough to pop that debt bubble. And of course, that debt black hole is just getting bigger. And I'm going to go over the monthly Treasury statement because I think every once in a while, we just need to drive home just how much debt there is and how much it is impacting the economy. So we got the monthly Treasury statement last week for May, and you're going to be shocked to learn that there was another big budget deficit. The Trump administration spent $292.65 billion more than it took in as revenues dipped due to the tariff refunds. Now, If you want some good news, you want to try to spin this in a positive way. The May deficit actually was down 7% compared to last year, but this is an illusion created by calendar effects. Last year, the end of May came on a weekend, so some of those payments were pushed into June. That made expenditures in May look smaller than they actually were. When you factor in those calendar effects, the May 2026 deficit was actually 32% higher than last year. So kind of looking at the bigger picture, there's 4 months left in fiscal 2026. The fiscal year runs from September through October. The annual deficit grew to $1.25 trillion for fiscal 2026 so far. That's down about 9% from the same period last year due to an influx in revenues. And the influx of money into the Treasury was in large part due to tariff receipts, which have provided a really nice boost to revenue over the last year. However, it looks like the tariff gravy train may be nearing the end of the tracks because customs receipts actually went negative by $42 million last month due to tariff refunds. Now, you'll recall that the Supreme Court ruled that those initial tariffs were unconstitutional, and a lot of people are wanting that money refunded. And so that is basically canceling out whatever tariff revenue is still being collected. Looking at the numbers, the government collected $21.93 billion in customs duties in May, and that was down by about $10 million from the peak, or $10 billion, from the peak in October. And customs receipts have actually been falling modestly since that October high. And then I already mentioned the fact that Uncle Sam had to fork out $21.97 billion in tariff refunds after the duties were declared illegal. And so that dropped customs revenue into the red for the first time in quite a long time. Total May receipts, combining the tariffs plus all of the other tax revenue, came in at $335.51 billion. That was down about 10% year on year. Through the first 8 months of fiscal 2026, government receipts totaled $3.66 trillion. That's up about 5% from last year. So we've actually had about 5% more revenue this year than last. That's part of the reason that the deficit is a little bit smaller. But that's a problem if that tariff revenue is going away, right? We're going to lose that gravy train. And the real problem continues to be on the spending side of the ledger. The Trump administration blew through another $628.16 billion last month. We've been consistently over $500 billion every month for quite some time. That drove total spending for the fiscal year to a staggering $4.9 trillion. That was about 1% higher than last year and set a year-to-date spending record. A 1% increase in spending might not sound significant, but weren't we told there was going to be spending cuts? And in fact, there were some spending cuts in the big, beautiful bill, but there were also spending increases. And on net, we seem to be spending more. The increased spending comes despite cuts to the EPA, the Department of Education's budget, along with staffing reductions that are now showing up in the data. We had lower disaster spending earlier in the year that helped moderate spending through the first 2 months of fiscal 2026. However, if you look at the big picture, the spending trajectory is up. Even with all of the hype about DOGE, we had some lip service to cutting spending during the early days of the Trump administration. The U.S. government spent just over $7 trillion last year. It's an average of $583.3 billion per month. That's $19.2 billion per day. Think about that. The federal government last year spent an average of $19.2 billion with a B every single day. Oh, and now there's a war. And it's unclear just how much of that war spending has actually showed up in the Treasury data so far. Defense spending is up notably. However, that doesn't tell the whole story. Last month, a Treasury official told Reuters that while the increase in defense spending reflects some of that war spending, the cost of the Iran conflict is actually being spread across many categories in the budget, including personnel and maintenance costs, research and development operations, procurement, etc. etc. A Pentagon official recently estimated that the federal government had spent around $29 billion on the war as of mid-May. So, that's the bottom line. No matter what the government tells you about spending cuts, they're always going to find ways to spend more money. There's always going to be a reason. There's always going to be a crisis, a disaster, a war, something that happens where, we have to spend this money. We'll worry about fiscal responsibility once we get through the emergency. And yet we never get through the emergency, right? Despite some non-specific talk about spending cuts, there seems to be little to no commitment to deal with this runaway spending. And that's exactly why many countries are saying, maybe we don't want to hold on to all of these treasuries. Maybe this isn't the best investment. Maybe this is not a good wagon to hitch our horse to, right? So that's where we are. It's par for the course. It's a lot easier to talk about spending cuts than it is to actually cut spending. And so I have no hope that we're ever going to see any end to this upward spending trajectory. And honestly, I think that the U.S. fiscal situation is only going to continue to deteriorate until it creates and precipitates a major crisis. The ugly truth is the government is not committed to cutting spending in any meaningful way, and it always finds new reasons to spend even more, whether it's the crisis at home or it's the war overseas. And the big problem here, or, not the big problem, but another part of the problem is that the cost of servicing this debt continues to climb in this higher interest rate environment as the government keeps piling on new debt. And this, ladies and gentlemen, is one of the major reasons I say the Fed is in a catch-22, because as much as they want to talk about keeping interest rates higher, this is a huge problem for Uncle Sam. Interest expense has grown into the second largest spending category in the federal budget, only behind Social Security. Go back to May. The Treasury forked out $132.62 billion just on interest payments. That was up 18.8% from the prior month, and it set a new monthly record. So far this year, the federal government has spent $866.82 billion on interest expense. That's up 11.7% compared to the same period last year. Interest on the national debt last year cost $1.2 trillion with a T, and that was up 7.3% over 2024. So you can see this upward trajectory of interest expense. It just keeps going up and up and up and up. Through the first 8 months of this fiscal year, the federal government spent more interest on the debt than it did on national defense or Medicare. Again, the only higher spending category is Social Security. So, it's not so much rising rates either, right? The interest rates are higher, yes, but it's primarily a function of the ballooning debt. The average interest rate on the U.S. debt increased to 3.35% in May. That was only up modestly from 3.29% in May of 2025. So the average interest rate is kind of steady. It's high. It's much higher than it was a few years ago when everything was zero. But it's really just more and more debt being piled on top. So you're paying interest on more debt, and that's what's driving these interest payments up. So again, I've said this over and over again, but this is the key takeaway. This is really what's driving my long-term thinking. Debt-riddled bubble economies don't function well in higher interest rates environments. It's not going to take much to pop this debt bubble. The debt black hole is bending everything in the economy toward it. That's what debt does. And it's not just government debt. I've talked about this before. It's consumer debt. Consumers are buried to their eyeballs in debt. They are using buy now, pay later to buy groceries. Corporations buried in debt. Central bankers at the Fed and the markets are speculating about their next move, seem to be ignoring this vital piece of the puzzle. So in other words, as I've said over and over again for well over a year, the Fed is still in a catch-22. So what Warsh says isn't really relevant. The central bankers are limited in what they can do by the massive debt black hole dominating the economy. Powell had the same problem. Warsh has the same problem. They may be different as night and day, but they're facing the same problem with the same tools and the same limitations. They have a choice. They can inject the rate hike medicine and hope it doesn't interact with the debt black hole, hope it doesn't kill the economy, hope it doesn't crash things, or they can feed the debt black hole with lower interest rates and more inflation to juice the economy and keep it stimulated. So yeah, speculation that the Fed will hike rates has put significant downward pressure on gold and silver prices really over the last couple of months. And conventional wisdom holds that higher rates are bearish for precious metals. But there is no guarantee that they will really be able to cut, no matter what Warsh may want to do, no matter what Warsh may say he's going to do. What he actually does is limited by the circumstances surrounding him. And if they do keep rates higher for longer, there is a high likelihood that it's going to precipitate a recession and or a financial crisis. Remember, we've never dealt with the malinvestments that came about through the pandemic. We still haven't unwound all of that stimulus that's in the economy. We still haven't unwound all of the financial malfeasance that happened during the pandemic era. And the fact of the matter is we really never unwound the monetary malfeasance of the Great Recession era. Remember, they tried to normalize rates in 2018 and failed because the economy got shaky and they went right back to quantitative easing. Of course, we're running quantitative easing now, right? And so the fact that the Fed apparently plans to continue doing so, despite all of the talk about inflation worries, reveals the difficulty of the path ahead for the central bankers over at the Fed. In the official statement, the FOMC, quote, reaffirmed its policy of maintaining ample reserves in the banking system. So what does that word salad mean? Well, it's basically code for we're keeping the balance sheet at roughly the same level. We're going to continue the balance sheet trajectory that we're on now, which is actually increasing ever so slightly because, again, the Fed right now is buying bonds on the open market. It is putting those bonds on its balance sheet. It is injecting money into the economy, money that was created out of thin air. This is inflationary, and it's happening now, and by all indications, the Fed plans to continue doing so. Now, Warsh has actually indicated a desire to drastically reduce the balance sheet. In fact, he has said if we get the balance sheet lower, we can keep interest rates higher. But there's no way that the Fed can dump all of its treasuries in the open market without driving yields even higher, driving interest rates even higher, driving that expense on the national debt even higher. Right? High interest rates are already stressing the federal government. You know, again, interest on the national debt set a record last year, more than $1.2 trillion. So the government needs the Fed to keep buying bonds. It needs the Fed to keep running QE. It needs the Fed to continue expanding the balance sheet to facilitate the out-of-control borrowing and spending. That, ladies and gentlemen, is the reality. So what is a Fed member to do? Well, talk about how policy is in the right place, crack the door open for a rate hike, apparently. But ultimately, they're going to have to choose. They're going to have to give the rate hike medicine and hope the interaction with the debt black hole doesn't kill the economy, or they can forego that medicine and pray inflation doesn't kill it. No good choice here, right? It can't do both. It can't prop up the economy and facilitate the debt while simultaneously battling inflation. Again, no good choice. But historically, when push comes to shove, the Fed has picked inflation. The Fed picked inflation after the dot-com bubble burst. The Fed picked inflation after the financial crisis in 2008 and during the Great Recession. The Fed picked inflation during the pandemic, and I think when the next economic meltdown happens, it will pick inflation again because it is easier to blow off, cover over, gaslight you about inflation than it is a crumbling economy. So, yeah, there's a new sheriff in town at the Fed, but his options are every bit as limited by economic reality as the old sheriffs. So that's why you might be wise to stop and think hard about following the herd and selling gold right now. Why you might want to take advantage of these dips in the price to actually buy some gold and silver. And I was talking to somebody the other day when I was in Mexico, actually, one of the guys that was a member of my team, and he was talking about his desire to invest in precious metals. He sees the importance of it. He understands that his dollar is being devalued, but he said he just can't afford to do it right now. So I told him about the monthly purchase plan that we have at Money Metals. The fact that you can, for as little as $100 a month, build your precious metals portfolio over time. You can buy a little bit at a time, and then eventually you're going to have a nice cushion. You're going to have a nice savings in real money that is not going to be devalued and printed away like fiat dollars. Something to check out. You can find that over at moneymetals.com, or you can give us a call. 800-800-1865. Talk to a precious metals specialist today. I say it every week, but these folks are fantastic. They'll answer your questions. They'll help you figure out how precious metals can fit into your strategy, into your portfolio, into your financial situation. So take advantage of the wisdom and knowledge that they have. Give them a call today. If you don't want to talk on the phone, I get that. You don't have to. You can actually go to moneymetals.com. You can chat with the precious metals specialist right there in a chat. Or if you know what you want, you want to get some American Gold Eagles, you want some Canadian Maple Leafs, you can find those products online. You can order online, pay online, and we will ship them right to you. Or you can have your metal stored in our state-of-the-art bullion facility in beautiful Eagle, Idaho. But do it today. Now's the time. You can start saving tomorrow, but that's just one day less savings that you're going to have when you actually need it. So do that today. So with that, we're going to call that a wrap for this episode of the Money Metals Midweek Memo. You can get more information about everything that I've talked about on the show today and a lot more over at moneymetals.com/news. And if you want to get the latest news and information relating to gold and silver right in your inbox, make sure you sign up and get yourself on our email list. Of course, you can subscribe to the Midweek Memo on your favorite podcasting platform if you haven't done that already. When you do, you will also be able to tune into our Market Wrap podcast every Friday, where you're going to get a quick overview of the week in precious metals, along with conversations between yours truly and interesting people from the world of gold, silver, economics, and investing. Thank you so much for listening to this show. I hope you have a fantastic rest of your week, and I'll be back again next Wednesday.